By late May of 2026, American investors had parked a record $8.28 trillion in money market funds. Trillion, that is not fear leaving the market. That is smart money sitting on the sidelines, fully loaded, waiting, and in the same stretch, Warren Buffett's Berkshire Hathaway was sitting on roughly $397 billion in cash and Treasury Bills, the largest pile in the company's history. Here's what almost nobody tells you. When the wealthy sense a storm, they do not panic sell into it. They quietly build the biggest cash position they can, so that when everyone else is forced to sell, they are the only ones left with money to buy. The crowd hears crash and pictures the rich losing everything. That is backwards. A crash is not where old money dies. A crash is where old money goes shopping. Let me be honest about the cost of not understanding this. If you believe a downturn is only a threat, you will do the exact thing that hurts you most. You will sell your good assets at the bottom in a panic to the very people who spent the calm years getting ready to buy them from you. Think about that for a second. The transfer of wealth in a crash is not random. It moves from the unprepared to the prepared on schedule almost every time. So stay to the end because the last one ties the rest together, and it is the mindset that makes every other move on this list actually work. We are going to walk through what the wealthy actually accumulate before the storm, with real numbers and real names, then the risk nobody admits, then the single idea underneath all of it. Start with the most boring asset on earth, cash and its cousin, the Treasury bill. That record money market pile is not an accident. Of Berkshire's war chest, roughly $339 billion sits specifically in short-term Treasury bills, paying somewhere around 3.7% while it waits. That is the key. The rich do not hold dead cash in a mattress. They hold cash that pays them to be patient. A Treasury bill is basically a receipt from the government that says it owes you money soon, plus a little interest. It is liquid, it is safe, and most importantly, it is ready. When prices collapse, that dry powder becomes the most powerful thing in the market. That is the first real lesson. Before a crash, the wealthy are not chasing the last few percent of the boom. Berkshire has been a net seller of stocks for over 3 years, trimming positions while the crowd piled in. At the annual meeting, Buffett said, "We have never had people in a more gambling mood than now, watching ordinary investors pay up for stocks and pour money into short-term options." While the crowd was betting bigger, the richest investor of his generation was calmly turning stock into T-bills and waiting. It's not one thing, it is a deliberate choice to trade excitement for readiness. Next, gold. The asset that only looks exciting when everything else is scary. On the 28th of January, 2026, gold hit an all-time high of around $5,600 an ounce. But the more telling number is who was buying. Central banks, the most conservative money on the planet, purchased roughly 863 tons of gold in a single recent year, far above the pre-2022 average. Why the sudden hunger? Because in 2022, about $300 billion of Russia's foreign reserves were frozen overnight through sanctions. That was a wake-up call to every central bank on Earth. Paper assets held abroad can be frozen with a signature. Gold in your own vault cannot. When the most cautious institutions in the world quietly stack metal, it is not a bet on getting rich. It is insurance against the system itself. Now, the part people misread completely. The wealthy are not only hoarding cash and gold to hide, they are hoarding them to spend at the bottom. This is Act 2. The buying. When a crash comes, good businesses go on sale alongside the bad ones. The prepared investor uses that dry powder to buy quality dividend-paying companies. The dull decades-old ones that keep paying a slice of profit every quarter at prices they have not seen in years. They are not trying to catch the exact bottom. They are trying to buy a great asset at a fair price while fear does the discounting for them. The cash was never the destination. The cash was the ammunition. They also buy the boring real assets that keep paying through a recession. Self-storage is the quiet favorite. The industry generated over $45 billion in revenue in a recent year, and it holds up in downturns for a grim human reason. People die, divorce, downsize, and move regardless of the economy. And all 4 of those need a storage unit. Demand that does not care about the headlines is exactly what you want to own when the headlines turn ugly. The rich buy cash flow that survives the very storm everyone else is scared of. Let me be honest about the honesty beat, the risk, because this is where the fantasy gets people killed. Nobody, not Buffett, not a central bank, knows when the crash comes or how deep it goes. Sitting in cash and T-bills feels smart in a crash and feels painful in a boom that keeps going because you watch everyone else get richer while you wait. Timing the top is a trap. Even the greatest investors do not sell at the peak. They sell early and sit uncomfortable for a while. And gold pays you nothing to hold it, it just sits there. So if the storm never comes, you carry insurance you did not need. This is not a magic signal to sell everything today. It is a mindset, and mindsets do not come with a countdown clock. Here's what almost nobody tells you about how the prepared actually behave. They do not go all in on a prediction. They keep a steady reserve of ready cash at all times, not just when they feel scared. So they are never forced to sell and always able to buy. They let the boring T-bills pay them to wait. And when the fear finally hits and the crowd is dumping good assets to survive, they calmly spend the reserve they spent years building, buying the things they always wanted at prices they never expected. Then they refill the reserve and wait again. It is a rhythm, not a gamble, and that is the final twist, the thing this whole game is really about. The rich are not buying gold or T-bills or discounted stocks. Underneath all of it, they are buying one thing: optionality, the freedom to act when everyone else is frozen. A record cash pile is not a prediction that the world is ending. It is the purchase of a choice, the ability to say yes when the whole market is forced to say no. That is why they seem to get richer in every crash. They spent the good years buying the one asset that only pays off when everyone else is out of options. Cash in a boom looks like a mistake. Cash in a crash looks like genius. It is the same cash. The only thing that changed was who still had it. Here is the one line to keep: a crash does not create wealth or destroy it. It just moves it from the people who have to sell to the people who prepared to buy. Picture two investors in the last calm year before a storm. The first was fully invested and thrilled, borrowing to buy more as prices climbed, certain the boom would never end, laughing at the friend holding cash. The second trimmed slowly, built a boring reserve of Treasury Bills, held a little gold, and endured months of feeling left behind. When the drop finally came, the first was forced to sell his best assets just to survive the margin calls. The second calmly bought those exact assets at half price with the reserve he spent years building. A few years later, they had swapped places entirely. One of them chased the exciting win right off a cliff. The other one just made sure he still had money the day everything went on sale. If you know someone still waiting for the exciting win, still all in at the top, send them this before the storm and not after. Then like the video and subscribe because the next boring asset is even better.